Reserve Bank Governor Lesetja Kganyago is saying interest rates are expected to rise every quarter for the next 3 years. Of course, going to be very tough news for consumers. Just how tough? Investec chief economist Annabel Bishop joining us now. Annabel, hello to you. Always good to get your thoughts on what the MPC has decided. Now is the time to bring in 25 basis points just before Christmas. Was it necessary? Is this what you were thinking was going to happen?
Yes, hi, Gareth. I certainly do agree that, we were thinking it was probably going to happen because the financial markets were factoring it in. In the money market, they have a curve called the forward rate agreement curve, and it's what markets price interest rates at, the interest rate pricing in the market. And of course, they've got a strong upward move in the repo rate, really of about 3% over the next 2 years. But I think maybe your question, is it necessary, is perhaps more important. And I really don't think it's necessary to do such a very severe interest rate hike trajectory going forward. Look, now a small quarter point, quarter of a percentage interest rate hike is not very onerous. And I think it does send a message to consumers that you need to be cautious. We're not going to have low interest rates forever. You need to manage your money and be aware that interest rate hikes are coming. But, certainly, an interest rate hike every quarter would be quite severe.
So why are we expecting an interest rate hike every quarter for the next 3 years? That's quite far down the road to kick the tin, I imagine.
Look, I would say that the FRA curve, first of all, only goes out 2 years. So it's really showing a 3% hike in interest rates over the next 24 months. I would say that's too harsh, that's too extreme. But nevertheless, I would warn that the Reserve Bank is certainly highlighting that they are on an interest rate hike cycle now. So no further cuts likely. And of course, interest rates unlikely to stay where they are now either over the next couple of years. So why are they hiking interest rates? We obviously have seen high inflation globally. We've seen a push up in inflation in South Africa as well recently. And of course, that's been from the rand weakness and higher oil prices. But that's not really the key reason. The key reason is that globally, interest rates are rising. We've seen interest rate hikes coming through from Russia, Brazil, Poland, from the emerging market economies. They're pushing up their interest rates. If we didn't hike our interest rates, we would have got much more substantial currency weakness. And, really, the bottom line is that the United States is going to start hiking into interest rates in maybe a year or two's time. And if globally monetary policy is becoming less easy, if you're left behind, you could see extremely severe currency weakness. And that, of course, pushes through into higher inflation as well. So for the Reserve Bank, it's all about controlling future inflation.
Yeah, the markets at the moment, as far as local currencies, you say quite weak at the moment. The rand against the pound breaking through that 21 rand to the pound mark last night and this morning, holding stable on that. So why do you think it's important for consumers to start pulling back on their spending? Annabel, I ask this because right now consumers don't have money to pull back on. We're all in the red already, and this is why things like interest rate hikes are going to hurt so much more over the next 3 years.
Yes, Gareth, yes. Look, I think, the bottom line here is that while we have had a small 25 basis point interest rate hike, other emerging market economies have hiked by quite a bit more. So the rand may have seen a bit of weakness and disappointment, but your question about, what should consumers do? I think this is really the point here. South Africa's economy is still very fragile. And of course, we had extremely harsh lockdown restrictions last year. They were far too harsh for the economy. That caused enormous economic pain. Of course, those job losses that occurred, they have not all been made up. We still have not employed all the people back who lost their jobs last year. And of course, with more people entering the jobs market as well, this is gravely concerning. I saw a report recently saying that middle income earners are being particularly hard hit by very high debt burdens, and of course the fact that they are accessing increasing debt counselling as well. So these are all enormous worries, and I think the fact the Reserve Bank's done a small interest rate hike when it potentially could have done a bigger one, and the fact that the decision was split, that almost half the committee argued against moving interest rates, shows that perhaps the Reserve Bank is not looking for as harsh an upward interest rate cycle as the markets are foretelling. But I do think that consumers need to be wary and, unfortunately, just be cautious about taking on more debt and, of course, assess whether or not it's necessary. Look, I think what we really need here is a much stronger economic growth in the economy. And for that to happen, we need to see the structural reforms being pushed through. As you know, there's been many political sources of differences, much opposition to many reforms that government tries to push through under Ramaphosa to stimulate economic growth. And absent those reforms, we're not going to see a quickening of activity and more job creation.
Yeah, and also it's got to be careful with the consumers, Annabel. It's perfect advice as well, remembering that Black Friday coming up now is not the time to actually go and get yourself into more debt. So Black Friday is certainly not going to be as cheap on a credit card as it might have been a couple of weeks ago. Always a pleasure. Investec's Annabel Bishop joining us this morning as well, Chief Economist from Investec.